Hey everyone, welcome to This Explainer. Today we are breaking down the absolute best way to invest and honestly why picking individual stocks is just this massive psychological trap for most of us. We're going to uncover why so many people get investing completely wrong and how a remarkably simple strategy can actually make you a millionaire. Let's get right into it.
So let's kick things off with a pretty wild question. Why is it that the smartest people out there often lose their shirts in the stock market? I mean, we tend to think that if you just have a high enough IQ, if you're a literal genius, you can just easily outsmart Wall Street. But investing has this dark side that really doesn't care about how smart you are. It all comes down to the danger of overconfidence and our complete inability to predict human nature.
And look no further than Isaac Newton to brilliantly illustrate this point. Even a certified historic genius like Newton lost an absolute fortune and went bankrupt trying to outsmart the market. As he so famously put it, he could calculate the motion of planets, but the madness of people, that was totally beyond him. This is your ultimate proof that stock picking isn't about IQ. I mean, if Isaac Newton couldn't reliably pick individual winners, what makes us think we can?
But let's bring this a little closer to home. The host in our source material shared his own incredibly relatable and honestly pretty painful journey of chaotic stock picking. Imagine watching your crypto assets absolutely tank by 90% because you couldn't react fast enough, or going all in on a single stock like Asia Cement purely based on some random news hunch. And like so many others, imagine panic selling your shares in a powerhouse company like TSMC during the chaotic COVID crash. It is pure emotional investing, and it just destroys wealth.
So, if picking individual stocks is a total nightmare of stress and losses, what do we do? Should you just give up and leave your cash rotting in a bank account? Absolutely not. Enter a literal magic number in finance: 72.
This is the rule of 72. It's this beautifully simple math formula. You literally just take the number 72 and divide it by your expected annual interest rate. Whatever number you get, that is exactly how many years it will take for your money to double. It's a great tool because it translates these abstract percentage rates into a metric we can all actually feel, which is time.
To put that into perspective, let's look at some real-world numbers here. If you just leave your money sitting in a bank savings account with a tiny 1% return, it's going to take 72 years to double. 72 years. But if you put it into a broad market index fund, like Taiwan's Top 50 Index, which has historically yielded around 7%, your money doubles in just 10 years. In 20 years, it quadruples. When you compare these routes side by side, the difference isn't just a few extra bucks. It is literally generations of wealth.
So, what's the ultimate fix to this emotional stock-picking trap? It's what's been dubbed the Forrest Gump method. Honestly, I love this analogy. Just like Forrest running relentlessly without overthinking it, this method is all about steadily buying broad market index funds like Taiwan 0050 or the US S&P 500 without ever stopping. Rain or shine, market up or market down, you just keep blindly buying that basket of top companies.
Now, why is this method mathematically and psychologically so superior? Well, picture this. Think of individual stocks as fragile glass balls, and think of broad market index funds as highly resilient rubber balls. This is an absolutely crucial mental model you need to adopt. Here is the kicker. Glass balls, they shatter. They can go to absolute zero. A single company can go bankrupt, succumb to massive fraud, or just completely lose its market dominance, and poof, your money vanishes forever. But rubber balls, they always bounce back. Even if a massive economic crisis drops a whole market index by 50%, history shows us time and time again that the broad market, the collective economy, will inevitably recover and bounce back even higher.
And this brings us to what I think is the most brilliant part of an index fund: its self-cleansing mechanism. It's perfectly illustrated by the massive rise and fall of the tech company HTC. When HTC was booming, its stock peaked at 1,300, and the index fund happily rode that massive wave of profit. But when HTC started to decline and lose its market value, what happened? It eventually fell out of Taiwan's top 50 companies entirely. And the old 50 index? It automatically dropped HTC and just replaced it with a new, stronger company on the rise.
So you absolutely do not need to be some Wall Street wizard, because the index does all the ruthless, logical, dirty work for you. It has zero emotional attachment to a failing stock, none. It automatically cuts the losing companies, automatically acquires the strongest emerging ones, and essentially guarantees its own survival and long-term growth. You just sit back and let the rules of the index do the heavy lifting.
Now, if you're still a bit skeptical about the undeniable math of consistent indexing, let's look at this fascinating retrospective experiment from the legendary investor Peter Lynch. This proves beyond a shadow of a doubt why you don't need to perfectly time the market to become insanely wealthy.
Okay, picture this. The The year is 1954. You decide to invest exactly $1,000 into the S&P 500 every single year on January 31st, totally regardless of what the market is doing. Just $1,000 a year. Over 54 years, your total out-of-pocket investment is $54,000. By the end of that 54-year experiment, the compounding power of the index turns that $54,000 into over $3 million. That's incredible on its own. But Lynch added a really clever twist to this. What if you strategically leaned into the bad times? The new rule is, every time the market drops by 10%, you immediately invest an extra $1,000. Over those 54 years, that 10% drop happened exactly 31 times. That means you only threw in an extra $31,000 in total.
So, what did that extra 31 grand actually do? Well, because you bought the dip when stocks were essentially on clearance, it literally doubled your final portfolio. Bam! You walk away with over $6 million. That is the astonishing, life-changing power of combining a steady index strategy with buying the dips.
Let's bring this back to local applications to really drive the point home. In Taiwan, a lot of investors are absolutely obsessed with high dividend funds, like the 0056, mostly because seeing that cash hit their account just feels really safe. But if you look under the hood at the fundamental design, true market trackers like the 0050 are driven by massive capital gains and corporate growth. High dividend funds, on the other hand, often consist of mature companies with totally stagnant growth that are just paying out their extra cash.
And, well, the numbers speak for themselves. Put these two on the exact same starting line, and the pure market index just leaves the dividend fund in the dust. Over a span of just a couple of years, the 0050 index pulled ahead by 137%. Check back a bit later, and that gap widened to a staggering 237%. Because of compounding capital growth, the market index mathematically crushes the high dividend strategy when it comes to long-term wealth building.
Look, we're all human, right? If you still have that burning itch to actively trade and, be the master of your own destiny, a brilliant compromise is the 80-20 rule. Just keep 80% of your money locked safely in passive index funds as your core. Then, use the remaining 20% to satisfy those active trading urges. And as a little secret weapon, experts suggest using tools like Taiwan's Economic Monitoring Indicator to accurately gauge when the market is overheating, which keeps those active trades of yours significantly safer.
At the end of the day, you really have to internalize this profound takeaway. True investing is not a trip to the casino. It isn't gambling on random stock tickers. The absolute essence of investment is practically participating in the progress and the growth of the world's absolute best, most first-class enterprises. When you buy an index, you are literally hiring the top CEOs in the world to wake up every day and work for your financial future.
So, as we wrap up this explainer, I want to leave you with one very important question regarding your financial future. Are you going to keep stressing yourself out, trying to catch falling glass balls that could shatter at any moment? Or are you finally ready to embrace the Forrest Gump method, experience the genuine peace of mind of an index fund, and invest in the rubber ball that always bounces back? The math is perfectly clear, but the choice is entirely yours. Thanks so much for joining me on this explainer, and happy investing.